This is The Answer, and we're going to be talking about money. Lots to cover today. A lot of things in my industry have been going on. They continue to go on. Some of those are impacting you. Some of the things that have gone all the way to the Supreme Court and decided in the Supreme Court. Some of the things haven't even made it that far, but it's affecting and could affect you. I want to begin talking about Alpine Securities, one of the nation's largest secured clearing firms. It was the largest, located in Salt Lake City. It was expelled by FINRA. It was expelled. It was expelled because they were doing unauthorized trading. They were converting customer funds to their own use. They were misusing customer funds. They were converting securities to their own account, from customer accounts, moving them to their account. And they were misusing customer securities. They ended up paying $2.3 million in damages, and they were ordered to cease and desist. One of the nation's largest clearing firms. I think there's some lessons to be learned. There's some things that if you have an account at one of the firms, any firm, you should be aware of and know what's going on. Alpine argued when they went to court, when they fought this with FINRA, that it was changes in the regulatory environment that caused them to do this. They claimed that there was increased regulatory security, and that was the blame, regulatory security and the legal expenses. I'll let you decide whether you believe that that's true when you hear the story, because it started in August of 2009, before COVID. So it was not a factor of COVID. It began before COVID. So here's what went on. During that period of time, from August 2018 to June of 2021, Alpine went through 3 chief compliance officers. That was already a signal that there was something wrong. Robert Tu and Christopher Dubeck, both chief compliance officers, both were terminated. Jason Kane quit in June of 21 because his decisions were being made without any advice from him, without any input from compliance. That's what happened. That was already a sign that there was something wrong. And yet that would not have been apparent to anybody but the regulators and anybody who was really astute in asking for deficiency letters, asking for what was going on in compliance. That would not have been apparent, but it was apparent to the regulators. It was apparent to somebody that was looking on as well. In 2018, the regulatory cost and the legal cost began to increase, and they increased significantly. And note, they didn't say it was just regulatory cost. It was legal cost as well. And because their costs were increasing, their profits declined, and they called it, in their court filings, precipitously. And so, in order to stay profitable, when your costs are increasing faster than your revenues and your assets, you either do a couple things. Either you accept lower profits, or you cut your services, or you add your revenues. And what they faced was not particular to Alpine Securities. Since 2014 through 2019, and that continued during the COVID times as well, 60% of the firms, both large and small firms faced the same issue. Revenues and assets were increasing, but costs were increasing faster than either revenues or their assets. Costs were increasing faster. So most companies had to face the question of, do we accept lower profits? Do we cut service? Or how do we add revenues? That's where things stood and have stood now for almost a decade, going back to 2014. And I don't know what was going on from 2008 to 2013. It may have begun during that period of time, during the Great Recession. I don't know. I've just seen what's happened since 2014. It's put a big pressure on firms that are both big and small. So the way that Alpine addressed it is this. You got to hear this. They announced they were putting a $5,000 account fee for retail customers. Now, if you're listening to the program, you're probably a retail customer. Can you imagine having a $5,000 fee, monthly fee, $5,000 per month added to your account? And they were adding a 1% per day charge if your account was inactive. Because as a clearing firm, as a broker-dealer, if you weren't making transactions and your account was inactive, they were charging 1% of your assets per day. You know, if you look at Adams Financial Concepts, our fees are among the highest in the industry because we feel that we deserve that because we do really extremely well for our clients. Our fees are at 2% per year. Alpine began to charge inactive accounts 1% per day. And if you wanted to close your account, they were charging $1,500 to close your account. You know, some firms charge 30, some charge 50, some charge 75. I don't know of anybody that charges $1,500. So if you're not happy with what's going on, you're going to get to pay $1,500 just to close your account. And it's not done. That's not all they did. Any position that you held in your account that was $1,500 or less was liquidated. They paid the customer a total of 1 penny for any stock that was liquidated. So if you're sitting there with a few shares that have tumbled down in this market and they started at 5,000 and they're now below 1,500, probably going to rally, go back above 5,000, but they're down below 1,500. Alpine would simply liquidate those and pay you 1 penny, not 1,500, not 1,400, not 1,000, 1 penny. Secondly, they looked at securities and they did that without the customers knowing it. And if they found securities in your account that they felt were abandoned or worthless, they would move them simply from your account to their account. They didn't tell you. They just did that. And they did all of that very often without the knowledge of the customer. Moving securities and cash from customer accounts to pay for the above fees was done without notifying the customers. Actually, the customers received a minimal notice. They received a negative consent letter, one that was sent to customers that said, if you don't respond, these are the fees we're going to assess. And they were just trying to say, we're trying to eliminate the small accounts. We want the small accounts to leave because those are unprofitable accounts. And of course we're going to charge $1,500 to close the account. But that's what they were doing. So what do you think? Listening to the program? You think those were fair fees? You think that was okay? That's a very big example. That's an extreme example of what's happening. Yes, they were shut down. The regulators came in, they shut them down, they expelled them, but that's just part of the issue that's going on in the industry. We're seeing that happen all over the place. Not as extreme as Alpine, but we're seeing since 2014 and probably accelerating in 2020-21 and into this year, we're seeing that 60%, maybe even a larger number of firms that have seen their revenues and assets rise, but their costs are rising faster. And you only do a couple things. Either you cut cost, you cut service, or you increase your revenues. I'll give you the opposite example. We're with Interactive Brokers as our custodian. Interactive Brokers is the firm that launched the zero commissions, and we're going to come back and talk about the impact of that after this commercial break coming up. But Interactive Brokers has gone out and they've grown from a couple hundred advisors when I started to 5,800. They have 17,610 advisors who have 15 or fewer accounts, and they've grown in employees from less than 1,000 to 2,600. And we're going to talk about the significance of that because they do more trades than Fidelity and Schwab combined. Fidelity and Schwab combined had over 100,000 employees. Interactive Brokers has 2,683 as of the end of the quarter. That's because they're extremely automated. Don't go away. We're going to come back and finish discussing this. We're going to discuss what's going on in 401ks along some of those same lines. Don't go away. We'll be right back. We've got so much to cover. For the program, I was talking about Alpine Securities. They were shut down by FINRA. They were forced to cease and desist. They were to pay a big restitution to some of the clients, probably not as much as the clients lost, but they got some money back. But what's been going on in the industry, as I mentioned, 60%, maybe even a larger number of firms are seeing their revenues grow more slowly than their cost. And it's big firms and small firms. Think about one of the largest firms was TD Ameritrade. And we began to see that back in 2018. TD Ameritrade, we keep our individual accounts at Interactive Brokers, but because they don't keep 401ks, our 401ks were housed at TD Ameritrade. And the way that we structure 401ks is that we try to pick the very best third-party administrator for doing the legal work and structuring the 401k. We try to pick the very best record keeper, and that's the people that do all the logistics. They take the money from payroll, they put it into the individual participants' accounts and allocate it into however the participants decides they want to invest that money. That's the record keeper. We tried to pick the very best record keeper. And thirdly, we wanted to have a very good custodian, which allowed separately managed accounts or self-directed brokerage accounts. And we found all that at TD Ameritrade. Now, the opposite of that is the bundled, where all of those things are bundled into one. So you have the record keeper, the third-party administrator, and you have the custodian, all doing that. And it's all one fee. Instead of picking the very best, you just get the bundle. And the firms love the bundled because they can hide a lot of fees and they can hide a lot of what goes on. It doesn't happen so much when you're picking the very best people. So TD Ameritrade, the first thing we saw, 2018, is they decided they were going to keep the bundled 401ks, but the unbundled 401ks, they wanted us out. They wanted to move that out, and we went to Broadridge for the custodian. And, of course, we kept the self-directed brokerage accounts at TD Ameritrade. They wanted those. Those are ones that did better than the rest of the 401ks. So that was the first thing that happened. And then came the zero commission transaction accounts. Zero commissions. Now, in a broker-dealer, you make money several different ways. You make it from transaction costs, those costs from doing trades, and that becomes a significant part. You make money on margin because if you have margin accounts, you're charging an interest rate, but you're making a spread on that interest rate. You make money from custodial fees and saving fees. Now, in a firm like Interactive Brokers, which is very, very automated, they do a lot of trades and they get a little bit of money from those trades, but they decided to put real pressure in the industry by going to zero commissions for retail accounts. Now, these are transaction accounts. These are accounts which were charged a fee, a commission, when trades were done. And that's now on fee-based accounts, there's still a commission that's charged. But on regular accounts, they did no fees. No fees, no commissions, because those accounts, for the most part, were at Interactive Brokers using some margin, and the margin was paying for those accounts. And when they did that, that put a lot of pressure on companies like TD Ameritrade, who was making most of their revenues from transaction cost, and E-Trade. TD Ameritrade, of course, you know, sold themselves to Schwab. They couldn't survive. Their revenues had already been increasing at a slower rate than their cost, and now their revenues were going to take a big hit. They sold themselves to Schwab. E-Trade, same problem. They sold themselves to Morgan Stanley. That's what they were doing. They were making a market. They had dark pools, but that wasn't enough to offset what was going on with their commissions. It affected large companies, and it affected a lot of small companies as well. You should know. You should know if you have an account that your firm could be in financial trouble. And if you start to see a drop in the service, if you start to see things that are cut, additional fees, you know that your firm is not keeping up revenues as much as it's going with service, as much as their costs are going up. That's one thing you should look and be aware of. You know, if firms are having to raise their fees or cut their service, there's some financial issues to be concerned about. So I want to shift. I want to shift and talk about Hughes versus Northwestern University. It was a decision handed down by the Supreme Court at the end of January of 2022. It was an 8-0 decision. And what they did is they overturned lower courts. The lower courts had said that participants, employees, had the ultimate choice of funds, so the sponsor and the advisor had really no responsibility for excessive fees. Now, it's me that says excessive fees. That's my opinion. But the courts, under the lower courts, had said by giving the participants a wide choice of fees, that covers the fact some have higher fees, some have lower fees. The participants can choose lower fees. We've gone in and we've seen 401ks that have 56 or 75 different fund choices. And if you're the participant, how do you pick and choose? Do you spend time going through each one of those and determining what the fees are? Probably not. You know, Tony Robbins wrote in the book, and he put it this way: the vast majority of people in the financial services industry care intensely for their clients. More often than not, they're doing what they believe to be in their best interest. Unfortunately, many don't understand how the house, that is the firms, Wall Street, reaps profits whether the client wins or not. They're doing the best they can for their clients with the knowledge and the tools that they've been provided. But the system isn't set up for your financial advisor. The system is not set up for the financial advisor to have endless options and complete autonomy in finding what's best for you, and it can be proven costly. Josh Brown, you've probably seen him on CNBC, put it this way: most of the brokers I know have met over the years are phenomenal world-class salespeople, but a great many of these security selling savants don't attain the knowledge necessary to actually accomplish anything for their clients. Selling one's expertise is much easier than actually developing an expertise, especially as it pertains to investing. You know, what this came down to is that mutual funds publish and tout their expense ratio, but they don't publish all the actual fees, many of which are hidden and which can be up to 60% of the total return. Just think of this. The expense fee, it's always put out there. But what they don't tell you is the cash carry cost, the cost of carrying cash in the account for liquidations or for funds that are withdrawn. They don't tell you about the asset management fees. They don't tell you about the 12B1 fees, or the marketing fees, or the trading costs, or the brokerage commissions, or the spread cost, or the marketing impact cost. They don't tell you about the soft dollar cost, or the redemption fees, or the account fees, or the purchase fees, or the record-keeping fees in 401ks, or the plan administrative fees in 401ks. In that same book, Tony Robbins' book, Money, the Master of the Game, says, and I quote, "I want you to imagine that someone comes to you with the following investment opportunity. He wants you to put 100% of the capital and take 100% of the risk. And if it makes money, he wants 60% or more of the upside to be paid to him in fees. Oh, and by the way, if it loses money, you lose, and he still gets paid. Are you in?" Most people don't do the math. The fees are hidden. Try this. If you made a one-time investment of $10,000 at the age of 20 and assuming a 7% annual growth over time, you'd have $574,464 by the time you're nearly 80. But if you paid 2.5% in total fees and other expenses, your ending account balance would be only $140,274 over the same period. So let's see if you've got this straight. You provided all the capital, you took all the risk, you get to keep $140,000, but you gave up $439 to an active firm, to the firm. They take 77% of your actual potential returns. And for what? For what? You know, the big thing that's coming down, the Groom Law Group has analyzed the Supreme Court decision, and what they're saying is it means that advisors are going to be really pushed because they can't include higher cost funds. That makes them subject to review and subject to legal recourse. Not to put in the lowest cost funds is going to be a problem. And you have to have some balance between returns and fees. You can't just look at the lowest fees. Secondly, it's going to include fewer funds because you can't just say, these are safe funds, and we included a couple safe funds, and we've got all these other funds. You can't include a lineup of 50 or 70 or 90 funds saying a couple are low fees and the rest are higher fees, and some are safer and some aren't. You're going to have to really think about the funds that go on. And you're not going to be able to allow record keepers to keep excessive fees. It's really changing. And that brings us to annuities in 401ks. We're coming to a commercial break. Don't go away, because there's a big thing going on with annuities in 401ks. A new lawsuit was filed on the 3rd of February, 2022. It's a suit that was filed by the Federation of Americans for Consumer Choice. It sounds like a really American, all-American pie. Baseball, apple pie, ice cream. I mean, it's given one of those names which sounds so good. The Federation of Americans for Consumer Choice. It was joined by several advisors and some advisory firms, all of them selling annuities. And their brief mentions that pouring the same old wine into a new bottle does not change the result. And what they're trying to do is they're trying to get rid of the Labor Department's new fiduciary rule as it was implemented just a couple years ago. And they're saying that they often roll over and make rollover recommendations for the purchase of annuities, and they make that to IRA owners. The IRA owners, and they make those same recommendations to participants in employer-sponsored 401k and similar benefit programs. And they get a commission for doing that. They get a very, very large commission, by the way. A very, very large commission, sometimes up to 14%. But they make that recommendation to people who are rolling from a 401k into an IRA. They make the same recommendation to employees in 401ks. And it's been a big push that they've made to push annuities into 401ks. And now they want to do away with the fiduciary rule because they say that they've been receiving commissions and they will be under scrutiny because they will be considered fiduciaries. They don't want to be considered fiduciaries. Fiduciaries can be personally liable for bad decisions, for decisions not made in the best interest of their clients. Now, why? In my opinion, why would any firm, why would any advisor discourage people from not wanting to be fiduciaries? Why would somebody not want to be a fiduciary? Because what are they selling? What are they putting into client accounts that they don't want to be held responsible for? How can they put something into a client's account that's not in the client's best interest? That's what this is about. They are saying that the decision made in the Chamber of Commerce case, it is because of that they're filing this suit, because the Department of Labor wanted to resurrect the substance of the vacated fiduciary rule. They are concerned that if somebody sells an annuity, they're going to be held to a fiduciary standard. And what they're trying to say is this. They're trying to say, we make the sale one time, and after that, we have no responsibility. What the Department of Labor is saying is, if you make a sale to a client and you put an annuity in an IRA, or you put an annuity in a 401k, a participant's 401k, you have the responsibility and you are giving advice. And if you're giving advice, then you fall under a fiduciary rule. The insurance companies, the American Federation for Consumer Choice is saying, no, that's a one-time deal. We sold it once, we get our commission, and we shouldn't be held responsible for what happens after that. We're not responsible for what happens after that. That's what they're trying to say. And they say that the Chamber of Commerce decision didn't turn on the question of how many instances of investment advice would be sufficient to demonstrate the existence of fiduciary decision, but rather the special relationship of trust and confidence that is in a fiduciary relationship. So it's not how many times you sell different products into a product. If you sell one, it turns on the relationship of trust and confidence that participant gives to the advisor and to the company that has that annuity. Do you believe that if you're sold one thing once, that advisor has no responsibility for that? That the insurance company that does the annuity has no responsibility for what happens? Isn't that what they're saying? Isn't that what they're saying? If you buy an annuity, aren't you basing that on trust and a relationship and confidence in the person and in the company that is selling that to you? Isn't there trust? Isn't there confidence that what they're doing is the right thing to do? The American Federation is saying, oh no, it's a one-time deal. We shouldn't be held responsible for it after that. It's a one-time deal. We're going to pay the advisor a ton of money, and let the chips fall where they may. That's what it is. And specifically, the suit claims that, and I quote, like the fiduciary rule before it, the new interpretation radically changes who will be deemed a fiduciary for the purposes of ERISA and the code. The hotspot is the new interpretation where the professional is going to be deemed a fiduciary, where they're deemed a fiduciary, where they're deemed to be making the decision in the best interest of their client. The insurance companies and the advisors do not want that responsibility. They do not want it. And the suit claims further that the semantic distinction is meaningless from a practical standpoint, as all investment professionals seek to establish and maintain relationships with customers and potential customers, not avoid them. All investment professionals seek to establish and maintain relationships with the customers and potential customers, and not avoid them. Now, wait a minute. Is there a difference between establishing a relationship with the customers and making decisions and making recommendations in the best interest of the client? What this suit claims is it's all about relationships, and there shouldn't be a responsibility for the advisor to make the decision or make the recommendation in the best interest of the client. It's just about the relationship. And it's about a relationship. I sold you one, and then I'm not responsible for it. I'll sell you something else. I'm not responsible for it. I'll sell you something else. I'm not responsible for it. It just is this whole thing of making decisions in the best interest of the client. It's not a new argument. It's the same old argument we hear again and again and again, is that the insurance companies and the brokerage firms do not like the idea that you have to make the recommendation in the best interest of the client. They just don't like it. They don't like it because they know they can be sued if they don't do that. And what they really want to do is they want to sell that annuity. They want to sell any other type of investment. And think about this. You've heard it before. If you've been listening to this program very long, you know my thoughts about annuities. You know that they've been oversold and they're not right for very many people. You know, Helen Olin, in her book Pound Foolish, Exposing the Dark Side of the Finance Industry, said there's two things about annuities. First, they're increasingly sold to baby boomers, worried about running out of money, and that's happening today with what's going on in the market. You'll see more and more of that. And second, they're so complicated and difficult to understand, and so many financial penalties very few people can understand, and they're sold for one and only one reason, and that reason is to make money for the financial advisors. Think about that. Sold for one and only one reason, and that's to make money for the financial advisors. They're not sold for the benefit of the client. And yes, there are a few cases where, in fact, in my 36 years, there is a case where I recommended an annuity for a customer, and there's a second case where I should have recommended an annuity. In one case, it was actually a relative whose parent died. They inherited a house, they sold the house, and within 2 years, all the money from the house had been gone. There was an RV, there was this, there was that, but the money burned a hole in their pocket. And when they got a settlement for an on-the-job accident, they talked to me about managing their money, and I said the best thing you can do is put it into an annuity, because I knew what would happen. If it was accessible, in 2 years it would have been gone. There was a second case of a young woman who was 21 years old who got a big medical malpractice. And I talked to her and I said, you're going to hear from more friends that you never knew, more family members that you never knew, and they're all going to have great ideas. They're all going to have can't miss ideas. I said, what you need to do is just refer them to me and I'll tell them no. Well, she didn't do that. So what happened is she drained all the money that she got. She should have been set for the rest of her life. The money went and drained. Don't go away. We'll come back. Need to know the reason why I changed from Fidelity, which was our custodian, to Interactive Brokers. At Fidelity, there were a couple reasons. One is a safety reason, a cybersecurity reason, because we were hacked and people did get into accounts. Nobody lost any money. No one was compromised. No one lost the identity. Within minutes, we realized that we were under attack. We shut things down. We changed all the account numbers of every client. Within 24 hours, every client had heard from us. But I realized that Fidelity didn't have all the safety walls in. And that was one reason to move to Interactive Brokers. Interactive Brokers is much safer. If you look at our website, you'll also find something that we've done and have done from the beginning is there's no client portal. So you can't log into your account by logging into our website. Completely blank. I can tell you that there was a time in which we were attacked, and every financial advisor is hacked. We are targeted because we deal with money. We're targeted all the time. And I can tell you that somebody came into our website. It was a young firm that had been on the radio show that did the website. And as time went along, that firm kind of disappeared. We had the website, and somebody hacked into our website. They changed the script in the website, and they were trying to collect usernames and passwords. Because we didn't have a client portal, clients never put a password and their password, their username, their password. None of that ever appeared. So nobody got, even though the website got hacked and changed, nobody had any information stolen. Nobody had any money stolen. Everything was safe. We're set up that way. And using Interactive Brokers, they have an internal, external email system. They have multiple authentication to get into your account. You have to know a lot of information in order to get to your account. In addition to which, we're set up so that every bit of money that goes out, unless it's set up on a monthly basis or a regular quarterly basis or some regular basis, it's already approved. Any money that goes out has to have my approval or our CFO's approval. My wife is actually the CFO. We have to know the client. We have to know the money is going out and it's going to them. If it's going to a third party, we will talk to the client, and we do know our clients so that we assure that money is never stolen. We're also set up so that the username and the password are completely off our system. Nobody's got the password, nobody's got the username except for the client. So it's all set up, and Interactive Brokers has it set up so that they have multiple authentication to get into the accounts. But that was not true at Fidelity, not at all. So that was one of the reasons to move. But the second reason to move had to do with something that's gone on which is affecting everybody. And that's the development of computerized trading. It began a number of years ago. But in 2010, there was a group that was formed by taking advantage of the difference between Chicago and New York. In Chicago, they're trading options and they're trading derivatives of stocks. In New York, you're trading the actual stocks themselves. So if you knew the stock price was changing in New York and you could buy an option in Chicago before that information traveled from New York to Chicago, you could make a small amount. And if you could buy in big enough quantities, you could make a significant amount of money. So what they did is they realized that the 825 miles, straight line miles, between New York and Chicago, if you could make a straight line, you could gain 4 milliseconds. You know, a millisecond is, there's 1,000 milliseconds in 1 second. You could gain 4 milliseconds. But fiber optics cables normally run along rail tracks, they run along right-of-ways. They wanted to make a straight line from New York to Chicago and cut 4 milliseconds. And the cost to do that, they raised $200 to $300 million and spent that. And they completed it in 2012. They cut 4 milliseconds off the time, just 4 milliseconds, incredibly small amount of time. And they were selling a lease on their system for $20 to $30 million annually, and they had a large number of companies that signed up and a long waiting list. That is the kind of marketing and kind of trading that goes on in the market that takes advantage of individual investors. There's 19 different exchanges. It's just not the New York Stock Exchange where stocks are traded. And taking advantages of differences between the trading prices between those has become a major issue, a major thing of which companies are making significant profits. They're trading very, very rapidly. And I noticed that when I was at Fidelity, that sometimes I would put an order in to trade. Maybe I was trying to buy 80,000 shares of a stock at 36 1/4, and I would put my order in to buy 80,000 shares at 36 1/4, and 100 shares would go at 36 1/4, and then the price would move to 36 1/2. The offer would go to 36 1/2. I had to pay 36 1/2 or 36 and 60 cents to execute. It was always that. It wasn't a huge amount, but it was always a significant amount. And what I learned is that my orders were going primarily to BATS, the exchange, and that was being front run. They would buy 100 shares, and then they would take all the other stock that was available at the prices between 36 1/4 to 36 1/2 or whatever it might be. If they could get the 80,000 shares, then they knew that I was going to have to pay 36 1/2 to buy the remaining shares in my order. And that really bothered me. It bothered me as well that Fidelity was allowing that to happen. Not only that, they were also developing dark pools. They called it blocks. In the beginning, they developed a dark pool. And what a dark pool is, it goes back to trading back in the 80s as large volumes began to build for trading. You had the New York Stock Exchange, the American Stock Exchange, and you had the over-the-counter market. At that time, it wasn't a NASDAQ yet. And the orders would come in, but if somebody had 100,000 or 500,000 shares or 1,000,000 shares to trade, that could just devastate the price. So what happened is that those blocks were traded off the exchanges. They were third-party exchanges, third-party trades, so that if Goldman had a client that wanted to sell 1,000,000 shares, the Goldman advisor would go to Merrill, they would go to somebody else, and they would set up a negotiated trade. Might be a 1/4 point, might be a 1/2 point, might be a 1/10 of a point difference. But they would set that block up so it didn't destroy the markets. But that began to develop into a significant volume because as institutions grew, as trading volumes grew, there became more and more of those. And eventually, firms began to set up what were called dark pools, where if Fidelity had somebody that wanted to sell 1,000,000 shares of stock, it would go into the dark pool and sit in the dark pool. And Fidelity then, their traders would go out and try to find buyers for the 1,000,000 shares. Or if it was a sell position, they would go out and find sellers that would fill an order. That's how it operated. And that dark pool, they were taking a 1/4 of a point or a 1/16 of a point or whatever it might be. They were making money. And I would look at some of the trades I got back. The trades would come through at the end of the day. And I knew they were trading in the dark pool. They were not trading at the best execution for my clients. So it wasn't a huge thing, but it was actually coming through and trading. All those things were reasons why I decided to go to Interactive Brokers rather than Fidelity. And it's been a positive decision. Interactive Brokers, they do have a dark pool, but I can see where I want things to trade. So if I want to trade on Smart, if I want to trade on BATS, if I want to trade on Island, If I want to trade on the New York Stock Exchange, I can choose the exchange on which I trade, and I can bypass the dark pool completely. If I have a big order, if I have a huge order, I might want to run it through the dark pool and have those trades done, and done as a market maker, done to the best advantage to my clients, either positive or negative. But if I have smaller orders, maybe 100,000 shares, maybe 80,000 shares, instead of 1,000,000 shares, I would rather trade those through knowing what exchange is buying those. And there are times when I sell small parts. Have a very wonderful weekend, and I will be back next Saturday to talk about money.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you've heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all.